Welcome back, everybody. Crypto is boring right now. A lot of people, including myself, are incredibly bored. And the prices are stagnant, consolidating, going sideways, contracting. A lot of them are just contracting off the highs. And we're waiting around. We're all wondering when moon, when Lambo, when pump. So I'm going to talk about in this video a potential different idea or framework. Just a guess, right? That some guy named Capital Wars published online about a 65-month liquidity cycle. All right, so a lot of people say in crypto, the 4-year cycle has been repeating like clockwork, really. I mean, there's no reason to think it wouldn't happen again, unless, of course, this time is different. But yeah, the 4-year cycle, as we know, typically it's 3 years of gradual price go up, 1 parabolic year, 1 terrible year, and then rinse, repeat. But it's obviously not that simple. When you're living through it day to day, if you're paying attention every single day, watching the charts, it makes people anxious, right? There's huge extreme volatility, and there's only so many times you could tell people that. But when you experience it, it's a different story, right? People's emotions get tested, their convictions get put to the test. And a lot of people, Bob Lucas, that guy, he popularized the left translated cycle theory, which basically just means, we have a top early and the cycle kind of is lackluster near the end rather than being super hot near the end and kind of gradual buildup, which is like, I guess, a normal cycle, you would say. Now, all kinds of people have all kinds of ideas. At the end of the day, we're all guessing, but I want to give you guys a different perspective on this new thing that I found that, what if really this time is different? There's a couple reasons why it might be. You've never had crypto existing in a quantitative tightening situation. Now, of course, they're going to have to print money again. Of course, they got proxy wars to fund and all this stuff. And on top of that, we've got mainstream crypto adoption. So we've got Bitcoin ETF inflows. We're going to have an Ethereum ETF at some point. BlackRock filed for one. BlackRock has a good track record. They usually get what they want. Mr. Larry Fink, he usually gets what he wants. So the Ethereum ETF is probably coming later this year, if I had to guess. Maybe even early 2025 if they somehow delay it. And that's going to keep money flowing in from the normies. Okay, that's Wall Street's on board now. That's going to keep 401k money flowing in, institutional money. Bitcoin's exposed to everybody, including all the normies that don't want to hold real Bitcoin or real DeFi, real PulseChain, real Ethereum. That's a lot of people, but their money pushes everyone else's holdings up, and that creates what's called the wealth effect. The wealth effect is basically, my portfolio is worth $100,000. Now it's worth $2 million. I feel rich now, so I'm going to go look around and I'm going to go shopping for some dirty little altcoins, maybe some alternative layer 1 networks, some meme coins. We saw that happen earlier this year. It was basically the wealth effect, but we still haven't seen, in my opinion, true retail adoption. Okay, my taxi driver is not asking me about Bitcoin yet. My random family members, aunts and uncles are not calling me up and asking me how to get in. Even though we've been telling them, this whole past 2 years during the bear market, the information's out there. Going back to the 65-month liquidity cycle, this guy, Capital Wars Substack, he wrote a paper. And it's got a lot of numbers and letters and algebra, guys. Look at these letters. These are letters that represent numbers. Wow. So smart. This guy must be smart. I'm not going to really break down all these formulas and stuff for you, okay? I'm just going to go to the very end and kind of show you what he predicts, what some other people predict. And like I said, guys, on top of the inflows from the Bitcoin Ethereum ETF, and there's a 6-month halving lag usually before altcoin dominance spikes. We're going to get to that at the end. Stick around till the end. Maybe it's always been related to macro the whole time. Maybe part of the reason crypto went up so much from 2009 till today is also just because they've been printing money like crazy and all that money's got to flow somewhere, right? At the end of the day, it's bullish. Okay, it's bullish. It's basically, this is the theory that buys us more time. This is the opposite of the theory of we already kind of had our top and it's going to be lackluster and, altcoin. The maxi theory, what the maxis want is for altcoins to die forever. So, the left translated cycle theory probably appeals to those people more because Bitcoin's already had a pump. But what they forget about is the altcoin dominance that always comes when people have this wealth effect that I just talked about. Historically, at least. And we look to the past to predict the future, and that's all we can do. No one's got a crystal ball. Again, we're all just guessing. So what are some of the guesses I've heard out there that are not left translated cycle? 65-month liquidity cycle. Basically, liquidity just means how much money does everybody have? How much money do all the businesses have on their assets, balance sheet, minus or plus the credit liabilities in the short term, plus they add in cash flows of households and corporations as well. So that's how they're measuring liquidity, at least at this Capital Wars Substack post. Okay, and you can follow at Cross Border Cap if you want to get some of this guy's more insights. We'll see if it plays out. It's just a theory, okay? But that would put And look, there's two different conflicting things here. So this tweet that I retweeted the other day didn't get a whole lot of likes. I think I don't know if I just didn't tag PulseChain or whatever, but I found this pretty interesting. Okay, I found this pretty interesting. This guy says that if you overlay the liquidity cycle onto the previous Bitcoin cycle, it almost lines up exactly perfectly with the top of the liquidity being at near the top of the Bitcoin price. And as you can see, when it goes down, we've been in red for the past, year and a half, and now we're risk on again. In this cycle theory, we basically are just getting started. Look at this small little ramp up, an inflection point right here, and now we're starting to be on the rise again. Now, this guy is measuring the global liquidity cycle. Okay, the global liquidity cycle, and if he extrapolates that off of the previous 65 months, it's basically every 65 months, there's one full peak, valley, peak. There's one full wave in the liquidity cycle. That's what that means. And he's saying the global liquidity cycle should predict the next peak of global liquidity, macro, to be around September 2025. So that gives us over a year to go still. This is very different than the 4-year cycle, okay? This is the what if it's different. And, I'm aware of my own biases of, wanting more time to pump as well. But when you look at the facts of the macro, this time really is different. I hate to sound like that, but you could make the argument that this time really is different. We've never had such mainstream crypto adoption. And look, if you count in the November election, if that shuffles some chairs around, if Mr. Gary Gensler gets kicked out, if he gets the boot, that's going to be good for all of crypto. That's going to be amazing. If we get some pro-crypto candidates in office, that's going to reignite the spark. Fingers crossed, guys, fingers crossed. One other thing, too, that this time is different is Bitcoin actually had a peak. It had an all-time high before the halving. How much meaning do you want to assign to that? Bitcoin has never topped before the halving. Some people think that's really important. Some people might not care, but hey, just one more reason to say this time maybe is different. But let's go back to this guy's prediction. This guy, he's saying next cycle high in June 2026. Why is he saying June? This guy's saying September. It's only a 3-month gap, so it's not that big of a deal. What this guy's doing, if you look at the picture here, I believe he is adding the crypto USD liquidity data. So this is what I think is happening, why they have different estimates. This is global liquidity for the global liquidity cycle, and this guy's applying a 65-month cycle onto the crypto liquidity data. So the crypto liquidity data would put us at a little bit earlier top in June 2026, whereas the global liquidity might peak in September 2026 if this random guy on the internet is correct, okay? And look, he seems smart. Look at all these letters, okay? Look at the algebra. Believe it or not, people that make models, economists are, famous for being wrong and all that stuff. But if you look at the very top, his kind of bragging point here is basically that, we use this to basically make all the Solomon traders rich, okay? This worked out for this trading firm and made a whole bunch of money by predicting the 65-year liquidity curve. So do with that information what you will. And on top of that, we've also got Bitcoin dominance here. Bitcoin dominance or altcoin dominance, so to speak. So I'm going to shift your focus now to this chart right here. And let's just get all this stuff in the picture so you can see. This is the Bitcoin market cap dominance chart. And I got to give a shout out to Alex Lorenzo for spurring this idea for me. Follow Alex Lorenzo. He's got some good ideas. I think that's his name on YouTube and Twitter. So he points out, you could look at the Bitcoin dominance chart. You could look at this chart and see this has data all the way back from 2014. So we only really have 2 halvening cycles in here, right? So sample set of 2, but when you're talking about 4-year cycles and the asset's only 15 years old, right? You don't have that much data to work with sometimes. So this was the first halvening date. These blue lines are the halvening dates. And the first halvening was around, July 2016. The next halving, the most recent halving, the previous halving from the one we just had, this was May 2020. And then, of course, the halving that we literally just had was in April. It was like 420, April 2024. All right. But look at this gap, right? Look at how long sometimes it takes. And I hate to be the bearer of bad news, but if we're just getting exposed to all the different scenarios that could play out here, this is one thing that could play out. Of course, there's always something pumping, right? There's always stuff pumping in the meantime. Like, you've got meme coin season on PulseChain going on. You've got crazy things going up 10, 50, 100x at times. And you could find that within crypto. That's why I like PulseChain. Look into it. Tons of opportunities even when stuff is boring. However, in a more macro view, taking crypto Bitcoin dominance, it usually takes 252 days, 238 days. There's a lag is what I'm saying. There's a lag after the halvening in which altcoin dominance is not rising, meaning Bitcoin maintains its power. But when you see the Bitcoin dominance going down, that means altcoin dominance is going up. That means that's the explosion. Okay, that's the euphoria. This is the blow off tops and all the different altcoin layer ones and DeFi and memes, all that stuff. But if history plays out like it's been playing out for the past 2 cycles, again, sample set of 2, but hey, we got to work with what we got here, okay? There would be a 250-day, so what is 250 divided by 30? Roughly, that's, 7-8 months after the Bitcoin halvening. I know you're probably thinking, 7 more months, 8 more months, I can't wait that long. Well, look, guys, you've already waited this long. PulseChain's only a year old. All right, PulseChain's only a year old. 8 more months in the grand scheme for euphoria to hit. If anything, that just gives you more time to build, accumulate positions, and that's what the PulseChain community's been doing, right? They've been building like crazy. I mean, think of how far we've come from an infrastructure level in only 1 year. We've got all these DeFi primitives, well-established meme coin communities, NFT marketplaces, working on fiat on-ramps, exchange listings, all this stuff that's being put in place now so that, it's almost a matter of what we do now to lay the foundations could directly impact how hard we pump, how hard the PulseChain ecosystem pumps, whether that's a 10x or a 1000x, anything in between. So the difference between, let's say, a 30x gain in PulseChain and a 400x gain in PulseChain, it correlates to how much attention we're getting now. And so if you have this 8-month period to buy you more time, and if things keep going like they've been going, here, I'm going to show you a pyramid really quick. I'm going to go on a tangent, and I want to talk about this little pyramid here. It's basically the creator, contributor, and bystander pyramid, okay? Creators at the very tippy top of the pyramid, contributors at the top 10%, and lurkers right at the bottom 90%. In an attention economy, this is what you want to look for. And if we know from pattern recognition that coins with a large community actually pump the hardest, regardless of if they have good tech, right? It's marketing, it's eyeballs, attention economy. What you see in the PulseChain ecosystem, the real alpha for the attention economy, is that the pyramid here looks different. Okay, I truly believe this when I see everything going on, when I see everybody building these little, these liquidity link protocols. You've got the Atropa ecosystem, you've got all these meme coins, you've got PTGC, you've got so many different yield farms out there, so many DeFi protocols, DeFi lending, DeFi, Aave forks, GMX forks, Fame Fiat, PHUX. So many people building. You've got a wallet. You've got zeroxcoast.com. You've got people building fiat on-ramps. This means when I look around that the top 1%, top 10%, let's say contributors and creators, they matter a lot. We have a lot more than 10% of the community that's actually doing stuff. Now, how many do we have? I don't know, 20, 30%. But the thing about PulseChain that's not like other communities, you see in other communities, a lot of people, they sit around and they want the developers to do something. It's the meme, right? Like, can the devs please do something because my bags are down? You don't have as much of that in PulseChain. You've got people actually taking it upon themselves to do something and to build, the future. So I've seen a lot of these other crypto quote unquote communities. Okay. They say they have a community. Really, it's 90% lurkers or more. Sometimes it's like 99% lurkers. And it's just the peanut gallery saying, hey, win moon, win launch, win updates. Devs, please pump my bags, do something. All right, and you don't have that attitude in the PulseChain ecosystem. From the very foundations, from the very beginning, people have been building, people have been making new whirlpools and contraptions, and you can call it Rube Goldberg machines, or if you want, don't get triggered, okay? Just a terminology, figure of speech. Places to trap attention, places where the eyeballs are going. Long story short, the top of the pyramid in PulseChain is a lot bigger than 10%. I don't know how big it is, but it's a lot bigger than 10. Yes, you're always going to have the lurkers. You're always going to have the bystanders that are sidelined, but think of all those guys as just the guys that are waiting to see if, Richard goes to jail or Richard pumps his own bags or something like that, right? And you've got all this money sidelined, and even the lurkers know about PulseChain. Everybody knows because the PulseChain community is so good at getting the message out there. We've got the brand recognition out there. Everyone's heard of it. They love it or hate it. They have an emotional reaction. They either want it to fail, or maybe they're secretly a supporter, but they're just too nervous to get in right now. And a lot of these lurkers, they're probably going to get in when the dominance falls, right? When it's safe to get in, when they have confirmation bias. See, people only like to buy things after they're popular, after everyone else bought it, so that they can feel like they're the cool kids at the table. They can tell all their friends at the bar, oh yeah, I'm in PulseChain. You know, I bought PulseChain because it just went up a whole bunch and everyone's talking about it. And they bought it yesterday when they could have bought it anytime in the past 2 years and still been up more. That's how simple some people are. They don't want to take an asymmetric risk. They don't want to build the future. And that's going to happen in every currency, right? That's going to happen in most of the altcoins. You're not going to see people piling in and true retail mania euphoria until, in my opinion, potentially 6 to 8 months after the halvening. So look where we're at right now. Look where we're at right now. We could obviously have short-term pumps in the meantime. 2x, 3x, 5x's in the meantime on the blue chips, on the other meme coins and stuff. 10x's, 100x's are happening all the time. You need to pay attention. Do yourself a service, do yourself a favor, and pay attention. Even when things are sideways, right, there's still opportunity. But all I'm talking about is Bitcoin dominance lag. All right, Bitcoin dominance lag. Going back to this tweet. A historic 6 month, maybe this should say even 7 or 8 month lag. Okay, maybe that should say 7 or 8 month before an altcoin dominant spike. You've got BTC inflows happening all the time. You've got Ethereum ETF coming. BlackRock, August. Look at the dates, guys. I'll show you the dates just to prove it to you. Okay, this is the blockworks.co tracker. And let's go find our friends, Mr. Larry Fink, the Finkelberry. BlackRock, August 7th. Look at this date. August 7th is the date for what? Final deadline. Final deadline. Now, who knows if they can push that around, but I don't know, guys. Might be a pretty good summer. Might be a pretty good summer, and that's only 3 months away. But like, the main point is that even though there's all these bullish things to look forward to, even though you could look forward to, you know, a different candidate in office, Gary Gensler gets fired or resigns, you know, hopefully, and maybe the regulatory environment in the USA gets cleaned up to be more crypto friendly and at least have some guidelines. Maybe things go well for Richard versus the SEC. Maybe things go well for Consensus. They're suing the SEC. MetaMask is getting sued, but the Consensus company is suing them back. Ripple won. Coinbase is probably going to win. You have a lot of these big, heavy hitters with a ton of money, ton of time. Richard's one of them. 11 lawyers all around the world. And they've got one mission. Their one mission is to beat the SEC and establish solid case law and precedent for the future. So you've got all this stuff to look forward to, but it's not going to happen overnight. It's not going to happen overnight. And at a high level, guys, a high level, just 65-month liquidity cycle. What if it's true? What if it's true? What if it's not a 4-year cycle? I know it's easy to just say, oh, it's going to be a 4-year cycle like every other cycle. And I'm hesitant to say this time is different. I am hesitant, but it feels different. Having been around since 2015, it does feel different. It feels like you've got a lot of unknown variables. You got AI. You've got the AI narrative. It's going to be a hot one, and they're going to incorporate that with blockchain. You've got Morpheus and all these projects with AI. It'd be cool if some of that came to PulseChain, to be honest. But what if it was, what if it was macro the whole time? What if it was the macro liquidity cycle that was really the dominant factor? Now, of course, this guy, he's only using the previous cycle, right? I would like to see if this was backtracked 2 more cycles, but you don't have a whole lot of data, right? You might not even have a liquidity index going back into 2015 or 2014. Maybe this liquidity index didn't even exist at the time. But what do you think, guys? What do you think about this cross-border capital dude and capital wars? Michael Howell, this Michael Howell fella. He's worked in finance for over 30 years. Formerly research director at Solomon Bros. He developed the concept of global liquidity. He's an author of Investing in Emerging Markets. He wrote a book, guys. A lot of economists write books, but hey, 65-month liquidity cycle was good enough for Solomon Brothers. It does line up perfectly on this chart. Just got to consider all possible scenarios. So I hope this was somewhat interesting to you guys. Like, subscribe, leave a comment, share the video. I'll be back with more stuff pretty soon. See you on the next one.